Beyond the Great Lockdown, Risks and Opportunities in Agricultural Markets. Our speaker is JP Gervais, Vice President and Chief Agricultural Economist with Farm Credit Canada. JP has years of experience analyzing domestic and international agricultural policies and markets, and his insights help guide strategy and monitor risk throughout the corporation. He is a frequent speaker at national and international conferences. JP provides commentary on the ag industry through videos. Among his previous roles, JP was Professor of Agricultural Economics at North Carolina State University and Laval University. He obtained his PhD from North Carolina, I believe. My screen just flipped over here, so, oh, pardon me. He obtained his PhD in economics from Iowa State University. Sorry about that. And with that, I would like to turn it over to JP. Welcome, JP.
Thanks so much for the introduction. I am going to, there you go. So that should be all set up and ready to go. Okay, thanks so much for the introduction. Thanks for the invite, especially. One of the coolest things in my job is that I'm able to travel really coast to coast and meet a lot of different stakeholders in the industry. And really, this is routine now. This is part of our lives, this virtual setting in which we are, discussing and sharing information and so forth. But just for the record, I still prefer the face-to-face, and I can't wait till we're able to gather again all together and like I said, share information, network, and learn from each other. So, but we just have to be patient. But I am looking forward to the opportunity in 2021. Talking about 2021, what I want to do today is to share with you what we're seeing in the industry at FCC. What is likely to have an impact on producers, the farm sector? What are the things that are going to contribute to farm health, or what are the also drivers or trends that can actually impede or be in the way of farm operations being successful? So really, it's about sharing what we have in terms of information, and if there's something that I go over quick or that you feel I'm not addressing properly or anything like that, I'm looking forward to discussion at the end of the presentation. I have about for 30 minutes of content here, so that should leave some time for questions and answers at the very end of the presentation. And just one last word so you can keep track a little bit of where I'm going with all of this is I always structure my presentation in two different parts. So, the first part is more of the big picture analysis of what is going on in the marketplace. And then I'm going to zoom in on the drivers in the ag market, specifically for the province of Manitoba. So bear with me, we're going to start very broad and then we're going to narrow it down to farm operations. Just a quick word, I'm not going to spend too much time looking backward. Really, I think today is about looking forward to 2021. But also want to spend a few words of where are we at right now in terms of the economic recovery, right? And at the outset of the recession, what we had really was an alphabet soup of different scenarios, right? So economists like myself were thinking, well, okay, we know we're going to get a recession in Canada and really a global recession of high magnitude for sure. But this is something, unlike other recessions, this is really something that we're imposing on ourselves, right? For good reasons, public health, but nonetheless, we're shutting down the economy for public health reasons. And so, if we're shutting down the economy ourselves, you can make an argument that this is going to be relatively easy and fast to reopen the economy again. And then you're going to get this V-shaped recovery, right? Where you're going to have a big drop in economic activity and then a fast recovery. Or you could get a slower recovery, right? Where this level of economic activity is going to drop real fast and it's going to, we're going to recover, but at a slower pace, drawing this U-shape type of a recovery. we've been in the middle of this second wave, some would even say a third wave of the virus, of the pandemic. And, with this idea of a second wave, the idea of a second shutdown, meaning that, you start, you see this contraction in economic activity, then you start growing a little bit, and then you shut down again, part of the economy. That triggers another decline in the economic activity and so forth. So that's the W-type recovery. And finally, the debate was also to avoid what we have as an L-type recovery, right? A decline, growth again, but never getting back towards where we were prior to the pandemic, right? To be in that spot where, because of some of the long-term damages to the economy, because of people losing their jobs, having to make decisions that are not in their best interest long-term, then you would find yourself in a situation like this. And indeed, some of the support that we've seen for businesses and households really have been targeting, or have been put together, rolled out to avoid an L-type recession. So, I'm not going to argue too much. Actually, believe it or not, economists, lately have been coming up with a different letter, the letter K. I'll say a little bit about that later. But it's the point being is, it's not to debate, what kind of recession are we in, but it's to understand where we're at and what is the likely trend or pattern in some of the variables that matter for farm health, right? Some of the financial variables that matter for farm health, right? Interest rates, the value of the Canadian dollar, those big macro variables, right? So at the world level, and as well, the strength of the demand for what we grow on our farms is function of the health of the world economy, right? So I'll say quite a few words about China, for example, and the role it plays currently in commodity markets. Well, if China is going to be able, the more China is going to be able to avoid this downturn, this economic downturn, and recover and rebound as fast as possible, then the more likely they are to have a positive role and positive influence on commodity prices, and hence profitability of Canadian farms. So on the left-hand side, what you're saying is sort of the world signals that we have, again, focusing on GDP, which is sort of the measure that all the economists use to understand and assess the health of the economy. And so you see some of the big drops, minus 5.7% drop in 2020 GDP in Canada. It's a bit too negative, I would say, probably going to be around that 5%. And if we're under 5%, I would call this a lucky scenario, a positive outcome, all things considered, right? 5% is a big decline. And just to focus a little bit more on the most recent picture on the right-hand side of the screen, you have the month to month, right? And the March and April decline were so deep, so big, that we're still right now, by the end of October, 5%, around 5% lower than the pre-pandemic level of GDP. And I think that's really the point, right? 5%, think about that, right? By the end of October, being 5% below where we were before this pandemic, that's still larger than the decline in GDP during the global recession of 2008 and 9 for Canada, right? We had a decline, the largest decline at any point in time during this recession was smaller than 5%. So you can understand the magnitude of this, right? That if you think of what we're going through right now and then compare that to 2008 and 9, the point is also that by the end of 2021, most forecasts are saying that we're not going to get back to where we were pre-pandemic. So, again, thinking that we're 5% below where we were, right? For 2021 to bring us back to where we were prior to the pandemic, then we would have to grow by more than 5%. And if you look on the left-hand side, the forecast is not necessarily that we're going to get there, right? So lots of a significant downturn. It's going to take us more time, right? The last few percentage points, right? Look in May, June, as we're starting to reopen, that's where it's easier to gain those percentage points in GDP and the unemployment rate, right? You're going to see jobs starting to grow, or we've seen jobs starting to grow again. But those last few ones, to get us to where we were prior, that's the hardest to get to, right? And that's going to take us some time. And so I think that's the number one message. And that's true for all the economies. China is actually in a very unique spot, really, frankly. I mean, the only significant economy in the world that's not going to record a decline for 2020. Part of it is because some of that pandemic hit them a little earlier than than for us. They managed to get the virus under control in a lot of different ways, or ways that perhaps are not necessarily available for economies like ourselves. So forth. Bottom line is, I think the picture looks positive for China, and that you'll see later that's going to have a positive impact on the overall. Obviously, what is going to happen in 2021 is also a function of the number of cases, the way that we're able to contain the virus, the success at which we roll out the vaccines and so forth, right? And you see a lot of countries, I pick Canada and then a few other countries that I think, are sending a bit of a different signal, right? So US is still not getting the second wave. I actually argue that's they're in the middle of that third wave, still growing. And still lots of issues south of the border. India has been a very large country that has been able to contain the virus. And again, as a major purchaser of Canadian ag commodities, if you think pulses, for example, well, that's a very, very positive as well. And then European countries are still, faced with some really some significant struggles in getting the virus under control. And just the case of Italy right here. I told you just minutes ago that Economist came up with a different letter to think of the current recession. So now I'm just focusing on the agri-food supply chain. And what this K-shaped recovery means is really that, there's part of the letter K that points upward and part of the letter K that points downward. And really what we're saying is that two-tier recession in which a subset of businesses and workers and households are facing a significant negative impact from this crisis. And there's another subset of businesses and households that are doing fine, so they're still, seeing their income grow and so forth, right? So if you look at the supply chain, if you look at crops, well, it's actually somewhat positive to see that, the last 12 months, when you look at GDP, it's profit really, right? So if you think of our crop farms, they've been managed to grow. Animal production is a bit misleading here, right? If you think of red meat in the non-supply managed sector, it's been struggling. Whereas in supply managed sectors, there's been some disturbances for sure, some disruptions. But overall, all things combined, you're looking at a small gain. Food manufacturing is also very different picture according to different sectors, right? If you think bakeries, for example, have been struggling, whereas dairy product manufacturing has been, seeing that GDP go up. So a lot of different outcomes, beverage manufacturer and so forth. Farm wholesale, which actually ties to the good news at the farm level, because the pace of our exports and shipments has been so strong that from a distribution standpoint, you've seen that sector of the economy do really, really extremely well. Food and beverage sectors, obviously, as people have been moving from food service to grocery stores, has been also doing well. And obviously, on the far right, the food and drinking places have seen their GDP come down. Okay, so what does it all mean? So I don't know if you see, I'm just going to skip this over here. All right, so this is, interest rates, and think of, working for a financial institution. One of the things that I'm asked all the time is, what about interest rates, right? Should I lock in some long-term rates, given that they're very low right now? Or flip side of that, well, if long-term rates are low, short-term rates are going to be low as well, right? And so maybe, there's a possibility to even, benefit from lower interest rates for some more time. So this is the line that you're seeing is an average. So it's think of all the different interest rates and out there, not just for farm operations, but really available to all businesses. Put all of that in the same basket, fixed, variable, 1 year, 3 years, 5 years, 10 years, and you come up with this average, this blue line there, right? The spring of 2017, I said, well, we currently have the lowest interest rates on record, and at some point this is going to trend upward, and so that would be a great time to lock in some long-term rates. And yes, sure enough, and I said at the time, I don't expect interest rates to come down this low again. Well, guess what? What I'm trying to illustrate between point A and point B is that, well, indeed, interest rates have been coming down. Our interest rates, on the far right, the most recent data points that we have, our interest rates going to remain at that level for some time. I think yes. I don't expect the Bank of Canada to raise interest rates until sometime in 2022. Having said that, the Bank of Canada controls short-term interest rates. So it doesn't mean if I'm saying that the banking is not going to raise interest rates before sometime in 2022, that you're not going to see other interest rate starts to go up. And it all depends on the vaccine. It all depends on the confidence that financial markets have in the economy growing again at the pace that we had before. And if you see that there is a lot more confidence, the labor market is getting close to where it was prior to the pandemic, businesses are reopening and so forth, and then perhaps that's the time to start thinking that, you know what, interest rates long term are going to start to go up. And so you may actually run the risk of missing out on the opportunity to lock in some long term rates at a very low level. So it's always something to consider. Having said that, I don't think rates are going to be coming down much lower than they are. And I, full disclosure, I said this 2-3 months ago. And guess what? They did come down. Now, of course, I'm not sure if I can use this pointer here, right? But what I'm talking about is this whoops, sorry. Can I point with my laser? This is what I'm talking about over here, right? This little bit of a decline. But again, you put this in perspective, and we're just talking about a few basis points, right? But the bottom line is that interest rates have been coming down. They're going to remain low for some time. And I think it brings a bit of relief to operations with the level of investment that we've seen, some of the expansion that we've seen on some farms, the level of debt that farms carry. I do think that's actually a positive picture. Okay, I'm just going to start now trying to, the second thing to notice as well, and just real quick here, is that there's a more and more discussion of this idea of pent-up demand, that there's a segment of households really that are saving more, which is really interesting to me, right? If you look at the Canadian saving rate at 14.6%, that's really high. It was 17, a quarter ago. And prior to the pandemic, it was between 1% and 2%. So, households have some disposable income to spend. So this idea of pent-up demand. And if travel is not going to resume real quick, maybe, when we start opening up again, food service and so forth, maybe that's one of the areas where some Canadians are going to feel like they can splurge. And I wonder what will be the impact throughout the supply chain. And we may be able to see some of that at, all the way up to the farm when it comes to livestock, for example. You'll see that, I don't think it's an issue for grains, oilseeds, and pulses, because I do think that the market dynamics are actually quite positive right now. So I don't think any of that's going to change this. But, if there's a silver lining for livestock, I do think that perhaps, this is the idea of, like, once the food service reopens, then maybe we can have Canadians splurging again. Now, of course, one of the questions I get all the time is, what about this deficit at the fiscal deficit that governments are running? So this is a picture as of September 1st. I'm just going to keep an eye on time here just to make sure that I'm stay within my time. This goes up, the deficit now with the economic statement that was released by the federal government. It's projected to be even higher than what this little point here basically suggests. We're probably going to get to 17% of GDP, right? And then that put things in perspective when you compare when we used to run the larger deficits in the mid 80s. And when it comes to debt, right, we know that the level of debt's probably going to jump over 50% of GDP, still under that 70% or close to 70% we had in the mid 90s, right? So at some points in time, and I'm not suggesting it should be now, and I'm not even suggesting it should be short term, we're going to have to get through this recovery and at some points in time address this deficit and debt. The good news is that if you look at the share of the budget allocated to servicing that debt, well, because of interest rates remaining low and staying low, and they've been on a downward trend for a while now, we've seen this line here come down. And then finally, when it comes to the Canadian dollar, this is an interesting situation. I'm going to focus on the light blue line. So this particular pattern here of the exchange rate for the Canadian dollar against the US dollar moving up, right? So the Canadian dollar is gaining value when this line goes up. And really, and that's the point of putting the euro there, is that if you look at our Canadian dollar against the euro, it's been roughly flat. So you have a flat line with a dark blue line, and you have an upward trending line with a light blue line. And what this basically says, it's not necessarily our currency that's gaining value. It's really the US dollar losing value. And that's, we may think this is an issue. And I do agree that overall, and I've said this in the past, it's hard for me to say the opposite of what I've said for the last 10 years, basically. I rather prefer to be in a low Canadian dollar environment. I think it's good for margins. Having said that, the flip side with a low Canadian dollar environment is that sometimes you tend to pay a higher price for inputs. So when we have a dollar that gains value, there's a couple of advantages. One is that inputs tend to be priced a little bit lower and than otherwise. And the second thing is that with a weak US dollar, which is really what happens here, right? It's not necessarily our currency that's gaining strength. It's really the US dollar that's losing value, which makes our Canadian dollar jump against the US dollar. But when the US dollar loses value, the positive thing, if you think of all the commodities that countries are importing from Canada, they're purchasing these commodities and they're priced in US dollars. So when the US dollar comes down, it makes their purchasing power go up, right? And so more purchasing power, stronger demand, and that's the benefit you see. But having said that, overall, I do think that we're better off in a low Canadian dollar environment. I don't see it breaking up 80 cents in 2021. But having said that, it's a little higher than what we thought, at 78. And I don't think, as long as it stays under 80 cents, and frankly, I think it could go to 85 and not put too much strain on margins of farm operations. But at some point in time, if it were to break 80 cents and go towards that 85, that's perhaps when I would think, wow, this is likely to pinch margins for operations. But right now, I just don't see this as an issue, but something to keep an eye on. Okay, so I did say that I was going to zoom in on markets, on ag markets, especially for Manitoba. At the end of the day, it's about global demand and production. And when you think about production for 2021, weather to me stands out as one of the issues, right? So that's what I'm going to emphasize. I'm going to start off by actually looking at our own 2020 estimates. I mean, it's a little bit early. We're kind of in a not curious, but a little bit, certainly for me, for myself, for my role, a little bit in a strange time or period here, because we're just got done with the estimates of the 2020 crop. A little bit early to actually have estimates of what seeding intentions are going to look like for 2021. We're just getting started, wrapping our mind around, well, what are the possibilities going into 2021, right? What do we expect producers' operations to look at in terms of seeding and so forth? So considering prices in futures markets, what kind of signals markets are sending and so forth, what has been seeded last year, obviously that has also an impact and carry forward to this year, to 2021. But if you look at where, smallest crop in canola in the last 5 years, that's function of the seeded acres, not obviously, but yields have been better. And that's been a good year overall. I mean, there'll be pockets wherever you are in the country for sure, where it's been challenging in terms of weather conditions and growing conditions and so forth. But overall, if you look at barley, you look at wheat, durum, soybeans, and then pulses as well, it's been positive. And so production's up. And the strange thing, though, this year has been that at a time where productions was up, and then you get the estimates in December versus the estimate of September relative to the 5-year average. But at the same time, our estimates were mostly trending up. Prices were also trending up, which is not usually what you would see. And so you have to go back to global markets to understand what's been going on. And a bit strange here, because I'm focusing on soybeans on the left-hand side. So that's the two charts here on the left-hand side of soybeans, or the stories about soybeans, and the story on the right-hand side is about corn. But hopefully you see where I'm going with this. Not the most seeded not the most popular crops in Manitoba. But having said that, I do think it drives a lot of what we're seeing in the global market. So for soybeans, I think there's a major reset in the animal protein market after ASF. China is successfully rebuilding their herd, and they're going to increase pork production, largest pork producer in the world. They're going to be able to increase their production in 2021. They've already done so in 2020. And that's a major reset, from what we had in 2018-19. And part of that impact, or the influence in the marketplace, is that it drives a huge amount of exports of soybeans and corn. The one thing at the top here, right, this trade deal between China and the US, at the end of October, they were just 44% off target, right? So think of the target as what they wanted to buy throughout the year. There was a commitment of 36 billion, if I'm not mistaken. If I don't know the exact numbers, sometimes I tend to not necessarily remember, but 36 billion worth of ag commodities, of farm products. Well, they're far off that target, and yet, even if they're far off the target that they set at the beginning of the year, look at the impact. Well, I haven't put any impact on prices. That's going to be on the next slide, but you'll see the impact that they've had in the marketplace when it comes to prices. So I find this very, very interesting. Right now, the pace of exports here is slowing down. So that's something to watch going forward, is that their pace of import is slowing down slightly. So something to keep an eye on, but it's still very strong, right? From an historical standpoint, especially if you think 2018-19. Now, corn, that's also a different story, whereas corn being imported out of the US again, here in this case, because that's the big producer in the world, and that's the big driver. China is the big buyer in the world, in the global market as well. Well, that has been somewhat muted historically, but as they're rebuilding the herd, you're seeing more and more being imported, and the forecast for 2021 is to exceed more than double what has been imported in 2020. So again, another big impact, and that potentially big impact is not even reflected here, right? So the green line is demand, purple line is production, and you see that for 4 consecutive years, we've had production under forecast production, if you think of 2021, under consumption. And so again, that supports prices quite a bit. On top of that, think of, for example, weather concerns or worries, I would say, in South America, and whether or not conditions are going to be too dry and so forth. And so just the size of the crop in South America in the market in early 2021, that's also weighing on in the marketplace. So if you put all of this together, right? So this is what it looks like for the prairies. So I'm just going to focus on the right hand side, and then look at the wheat futures market and the canola market here. You see the upward trend in pricing really starting from August onward. Now there's been a little bit of up and down, less convincing as an upward pattern for wheat than it is for all the different commodities. But nonetheless, I mean, there's been an upward pressure on wheat prices. Now there's been a little bit of a decline that started in mid-October, and now suddenly, with some of the concerns coming out of Russia as to whether or not they're going to be able to meet their export target and meet some of their customers' needs, just because of their own food security issues, and the idea that they'd like to restrict their exports so that the domestic price that they have for wheat is not climbing too fast. All of that has had an impact, and this little bit of an uptick in pricing here on wheat futures has been what is coming out in terms of what we learned coming out of Russia. So overall, some pricing that is quite a bit more positive than what we've seen at the outset of the pandemic, and certainly for most of 2019. If you look at canola, it's been a market going between 425 and 475 a ton. And then right now we're flirting with $600 a ton. So it's been a pretty significant development. And of course, on the left-hand side, what this is doing is actually making some assumptions about yields, making some assumptions about prices for the 2020 crop. So this is the 2020 crop being marketed in 2020 and 21. You know, as I said, we're a little bit of the peculiar time now. I expect that for some operations, maybe a significant share of the crops fully priced and so forth, right? So looking forward to pricing the 2020 crop, that might not be super useful, but as I said, we're just at the point where we're starting to think of the 2021 crop, right? So in that curious period in between, you know, harvest is done, big deliveries, and thinking about that 2021 crop. But I do think that if we're, I mean, some of the yields, the positive yields we've had as well have been also supporting margins. But while you don't see it up on the screen, if I were to put the same kind of chart here, profit margins, right? So expected fall revenues relative to average variable costs, or if you account for an average fixed cost, that gives you the light blue bar, right? So depending on where you're at, right? In some operations would have very small fixed costs just because of the stage they're at, not having gone through an expansion and so forth. So their costs would be lower and so forth, right? So everybody's going to be different. The yields are going to matter quite a bit and so forth, right? But the point is that if you were to see the couple of charts for the previous 2 years and 3 years, you would have a chart that speak of much tighter margins than what we have right now. And so I think that's the positive, right? To see quite a bit of space here and there and so forth between those different, you know, the costs and prices are going to bring a sign of relief, are going to bring some relief to farm operations overall. And that's just, again, an average, and some, you know, operations are going to be better off and some others are going to be worse off. You know, if you think of soybeans, you know, those are based on assumptions in Ontario. So this is what I'm calling Central Canada here. But nonetheless, right, you know, of course, make the adjustment for yields between Ontario and Manitoba. But bottom line is, with the run up that we've seen with soybeans flirting at $12 US dollars a bushel, the run up that we've seen in August, the run up we've seen in corn prices, I mean, those margins look good. And if you're able to get the yields, that looks like good profitability right now. So what does it look like from a revenue standpoint? So I'm going to highlight a few things, and maybe I can actually use this here, right? So just look at this. Whoops, I didn't mean to draw this like this, but it looks like a face of a cat or something. Just the difference between where we were after 3 quarters in 2019 versus where we are after 3 quarters in 2020. And, you know, there's a number of different things to consider here, but that points to me to a better year into 2021 from a revenue standpoint, both gross revenue as well as net revenues. Now, question is whether farms were able to cut back on expenses in 2020. I would say to some extent, yeah, they face lower input prices in some cases. But overall, I do think that I do expect a bit of inflationary pressure on expenses. I mean, it's a bit of an unknown what it's going to look like at the end of 2020. But gross revenues, I mean, there's no doubt in my mind that, you know, farms are going to be able to see a higher revenues. I mean, the just the mix of crops, you know, if you think corn and soybeans and I'm not exactly sure why this does this, but this is what it looks like, you know, for Canada as a whole, right? So you see more of a difference between 2020 and 2018. But the bottom line is, compared to last year, definitely a better outlook from a revenue standpoint. And that's going to bring a bit of relief to farms that have been struggling with some difficult weather conditions, you know, in the last few years. And I do expect Q4 to show an increase in overall revenues for 2020. And with strong pricing that we have, the ability to lock in some of those strong prices into 2021, I do expect that's going to also sustain 2021 revenues. Of course, the 21 crop is going to matter a great deal when it comes to revenues, but the 2020 crop being marketed in 2021, given some of the prices we have in the marketplace, is going to be positive. Just a quick word on livestock. You know, it's been challenging, right? And you know, if you look at U.S. fed cattle futures, you know, on which the Canadian price based off, look at the same kind of picture for hogs on the right hand side. I mean, you see that in that March to May, June, it's been difficult, very, very difficult. I mean, some of the plant shutdowns that we had, not only on our side, you know, in Canada, but also south of the border, managed to actually create a backlog of animals, and we're not yet through with the backlog of cattle, and then we have in the east some backlog of hogs as well. That's key, you know, and hoping that, you know, with the vaccines that we're going to be able to avoid that situation in 2021. There is a pivot in the animal protein sector. As I said, China has been such a big driver of some of the prices we've seen in the marketplace, aside from some of the plant shutdowns and some of what you're seeing here for 2020. Our exports to China are strong. I do expect that to continue, but I see very limited upside, right? So in other words, it's probably what we had in 2020 is perhaps the ceiling when it comes to 2021 as China is rebuilding the herd, right? And one of the drivers that is potentially are going to be supporting livestock prices is the fact that production in the US is slowing down as well. So I think that's going to support some of the pricing going into the spring of 2021. And I think that would be much needed relief, because those margins, you know, if you look at a typical Canadian livestock operation, they've been losing money. And depending on the sector, whether hogs or cattle, depending on what level of the supply chain you are, you know, farrow to finish versus just a finisher versus weaning pigs and so forth, all of that matters in terms of the profitability. But it's been really difficult for livestock operations in 2020, and I'm hoping that 2021 is going to bring a side of relief. And then you can see it right as well, you know, again, comparing that 2020 versus 2019 third quarter, you know, the cumulative impact of the first 9 months of the year, you see that we're worse off than where we were from a gross revenue standpoint. Actually, my surprise is that we're not lower than what the data says where we are. So I wouldn't be surprised if we have some data revisions pretty soon, and that, you know, Q4 shows up a little bit worse than what we have here for Manitoba hogs. And so that's something to keep in mind. And I'm going to end, so just give me 3 minutes, and that should leave a little bit of time for questions. I'm going to end with just a little bit of a discussion on land values. This is a picture for all of 2019. This is obviously data, right? So we've got Manitoba here at 4%. If you look at the picture for the midpoint that we had in 2020, right? So this is us assessing land values, you know, according to a few benchmarks we have in each of the provinces and so forth, right? And it's always relevant in my head. It makes more sense to compare the last 12 months with the previous 12 months, right? So we do that every 6 months. And as I said, 4% for the entire calendar year 2019. In the last 12 months ending June 2020, we had roughly the same pace of increase in Manitoba. A little bit slower pace for 6 months, right? So what would the last 6 months of the year look like? I am thinking that we won't be seeing anything over 4%. I would still think that, you know, at the end of 2020 would be in that 2 to 4% range for Manitoba land values, which makes sense to me, given that we've had a few issues when it comes to you know, farm income over the last few years. Now this year is going to be a good year, so that's something to watch. And I'm curious to see, you know, we're just starting to compute the data, just starting to collect the data and actually make the computations. We're going to be releasing the 2020 results sometime in mid-March. I'm quite curious to see if strong farm income coupled with, especially for grain, oilseed, and pulse producers, as well as low interest rates, if that's not going to trigger a bit of inflationary pressure on land values. And so I don't think that to be the case from what I'm hearing. The anecdotal evidence is that, you know, we're going to be remaining in that range and perhaps a little bit lower than 4. But having said that, you know, it's the curiosity that I have, you know, once we have all the data and then we understand what we're seeing in the marketplace, you know, to understand also we're able at the end of the calendar year to report by region. So that should give you a little bit more information for those of you that are interested in, you know, where land values are in their in their region. And so I'm just going to end on a positive note. I do think that there's a rebound on the horizon. I just think that we have to have realistic expectations as to how long, from a broad economy standpoint, if you think of Canadian economy, how long this is going to take us to gain back everything that we lost during the crisis. It's going to take some time. And it's going to be, we're going to have to carry this weight for a couple of years. And the recovery, it's going to take some stimulus and so forth. So this is far from being done. You know, the vaccines bring some hope, some economic hope for sure, some health. Obviously, from a public health standpoint, those are good news. Brings a little bit of economic hope as well. And as we're able to reopen the economy, I think domestically, I think there's some positive signs that Canadians are going to be supportive of the food supply chain. And hopefully we see some of the positive impact at the farm level. But keep an eye on the global factors, right? And that's my point, you know, with this middle picture here. Global demand right now is so strong with some production challenges throughout the world that, you know, if we can, you know, if 2021 ends up being a good year, I think we're going to be all right, you know, on the farm level. It is really amazing to see the strength of the demand for what we sell. So I am going to end here and maybe stop sharing my screen and then go back to this speaker view mode and maybe look to see if there are any questions, and I'd be happy to discuss and take those questions.
We do have one question here, and I can read that out. In the meantime, we do have quite a bit of time for some other questions, so I encourage you folks to please type into the question and answer any questions that you might have for JP. The first one is, do we see the confidence in the Canadian dollar versus the US dollar directly related to the COVID response incidents?
I'm smiling a bit because I was going to start my answer with, this is a really great question. And have you ever noticed that, you know, everybody that answers a question or answers a response as a good question, sometimes it's because you don't necessarily know how to answer the question and you're buying time, which is exactly what I'm doing now. Reality, you know, I'm just humor aside, is I don't know. I am surprised of the strength of the Canadian dollar. I think the markets are getting ahead of themselves. Now, what's the reason behind it? You know, do the markets have better confidence in our ability to get out of the health crisis faster in a better spot than the US? Not sure. Does the market lost confidence in the politics in the US? And because the one big piece of news to watch now for is the stimulus package in the US, right? And as soon as you see this move forward, and you would think that the markets are going to be really positive about it, and then you'll see the stock markets go up, and I would think that this would bring up the US dollar, and then we're seeing a little bit of movement there in that discussion between, you know, at the Senate level, which is really just the only level of US government now that is likely to remain split, although there's a runoff election in Georgia, which could change the entire picture. So is it, you know, our ability? I tend to think no. Historically, markets have paid really little attention to our economy just because of the size of it, right? And it's been mostly all about the US, you know, historically. Maybe we've seen a shift in mindset from the financial markets, you know, who knows? So I would still think, though, that it's mostly about the US. And as soon as we see the US transition to the new administration, and we see that there is a semblance of normalcy in the US, putting the disease behind them, rolling out the vaccines, somewhat managing to agree on some sort of stimulus package and so forth, maybe then we see the US dollar gain value, and then we see the Canadian dollar retreat back a little bit. That would be, but having said that, you know, I'm the first one to admit that, you know, our assumptions about the Canadian dollar have been not accurate. You know, we've been using a 75-cent dollar for a while now. I mean, obviously we revised upward to 77 in 2021, but look at where we are, right? We're above our forecast, our average forecast for 2021. And that looks to me as if we're going to remain wrong for some time.
Okay, the next question. What impact are you expecting the carbon tax to have on our Canadian outlook?
Well, we don't necessarily project as far into the future as, for example, what has been announced with just this week with regards to a carbon tax and how this is going to be rolled out and increased. So we don't make projections this way. So it's really hard for me to say what kind of an impact this is going to have on profitability. We know there's tons of measures out there that have been computed, some by provincial governments on the impact of the carbon tax, and some by producer groups as well. I have none. I mean, what I'm doing is we're basically using what our input prices are showing up in the marketplace and try to just apply that against revenues or expected revenues based on prices and yields. So this is definitely an area to watch and monitor. I mean, some of the compensation or offset measures uh, could potentially be a benefit to operations. And the way that this is going to be rolled out is really what's going to matter in terms of profitability. So I'm really not in a spot to really put some numbers around that. It's too far off in the future. I do think that margins, going into 2021, I'm hoping that, the support we're seeing from a commodity price standpoint is going to be supportive of margins. But, I think everybody here on this call has a super critical role in terms of supporting farm operations, right? So the value that you bring in terms of making sure that our, farm operations are moving to be more efficient and so forth are going to be a much bigger driver of profitability than anything else, I would say. Right? If you look at our portfolio of customers, it doesn't matter, small, large, medium size, no matter the size. I mean, we find differences in efficiency right across the board, right? So if you look at, expenditures on inputs versus what farm is able to gross in terms of revenues, what we call the expense ratio, your cash expenses relative to your revenues, find differences across the board, no matter what the size of the operation is. And so I think we got some room here to gain more efficiencies. And I do think that is a major role that all of you have to play in getting us, getting the industry there.
Okay, next question. I'm keeping a close eye on the time, but we'll do as many as we can. When you look at the slowdown in exports recently, what does this mean in your mind for 2021 new crop pricing opportunities?
So I am of the opinion that if the opportunity is present to lock in some of the 2021 prices, then this should be strongly considered. Um, there are too many mixed signals coming out of China in terms of their ability. I was just reading some report coming out of a Chinese news agency, so not sure what kind of weight to assign to this, frankly, right? Why should I be paying attention to that, or should I just dismiss it? But the report read as that at the end of 2021, they will have rebuilt the herd. And if that's accurate, then I don't see any reason why, we should see any type of slowdown in the pace of purchases that we've seen, in the second half of 2020. And I mean, I'm talking for grains and oilseeds here, and even be higher for some of 2021. So that opens up the door for quite a bit of upside. But I'm also suspicious of some of the reports. I tend to trust more the USDA numbers that have a little bit more of a objective flair or objective side to it. And on that, in that sense, maybe, we're likely to see exports being sustained at the level that we have had. And perhaps that's the floor that I'm looking at. And at that floor, I think that brings opportunities to price some of the crops and lock in some profits that I think should be seriously considered.
Okay, if this is a demand-driven rally for oil seeds and feed, how long do they tend to last?
Well, I just going back, so this is a really good question again. Going back to what I said about coming out of China, right? So how do you, if indeed their ability, they're where they say they are in terms of rebuilding the herd, I think it can be sustained, and I think it can be add a little bit of fuel, so to speak, on the rally if we got weather issues in South America. So that the size of that crop short term, I think that all eyes should be on that supply. because that's going to determine, what kind of rally we have, in the or what kind of pricing we have going forward for the next few months in the oilseed market. But I do think that demand is absolutely real. The other thing as well that has been that I don't think I've mentioned today is what kind of relationship the new U.S. administration is going to look to have with China. But having said that, there might actually, if there's one thing that President Trump can leave as a legacy that may be lasting in terms of impact in the marketplace, might be actually this relationship with China. The fact that the U.S. is probably going to look to have China commit to its word, and actually, meet some of the targets that they stated that they could. And so, if that's the case, again, I think that this rally could have some legs.
Okay, we still have more questions, but we've run out of time. So we certainly are appreciative of you sharing your time with us, JP. Great presentation, and certainly lots of interest. And thanks for joining us today.
Thanks so much. Always a pleasure.